Hey traders, and welcome back to the Forex Market Preview. I'm your host this weekend, Charles Miles, professional trader and trading coach here at TradeEmpowered.com. I wanted to talk about some today. I'm not really in a position to be in front of my charts here, and I also think that this short session that you'll be a part of right here will be more valuable to you than any trade idea or signal or strategy or whatever I could give you. More importantly, not that that's not important, but that most of you, 60,000, 70,000 people on the YouTube page on this channel, and also almost 30,000 people on our email list. If you're not subscribed to the email list, make sure you go ahead and do that. Head on over to TradeEmpowered.com. Click on the Learn to Trade tab at the top, and then sign up under the free training notification box. I believe it's at the top of the page. That'll make sure you get on our primary email list so you don't miss any new releases of software or training events or whatever else we might send out, which includes this Forex Market Preview video here on the weekend. Of course, also, if you're new here on the YouTube page, please subscribe. Subscribe to the channel so you don't miss this and any other trading content. As you guys have noticed, we've been active and fulfilled the promise that we said that we would all start to be posting training content about trading, specifically in the Forex markets for you all here on this channel. Again, we have a team of traders here to help, and you guys have no doubt seen those videos coming out. So just a lot of great extra free content for you guys to see if you're subscribed to this channel. There are playlists on our channel for each one of us traders there. There's a Forex Market Preview channel, playlist, There's a playlist for myself. There's a playlist for Akil. There's a playlist for Jason Greystone. So make sure you guys scroll through on the channel here at Trade Empowered and check those out. So I said today, guys, find out if you will be profitable in less than 10 minutes. Now, this video may take more than 10 minutes, but the process in which you need to go through for the formula I'm about to show you is probably less than 10 minutes. But trying to be safe and give you something that sounds intriguing, yet probably even take you less time than that. So what do you need to do this? Well, you need a couple things. You need to know what your average winner is. Now, this can be in dollars or points or ticks or pips. No matter the market that you're trading, you need an average winner of some kind. I don't care whether it's dollars or whether it's pips. In this case, we're in Forex here, so we'll go with pips in our examples. You also need to know your average loser. You've got to know that. You also need to know your win percentage and your lose percentage. Now, if you don't have these to begin with, that's a problem. You need to know this data. This data is imperative to you knowing if you are a profitable trader. And what I mean by are, you may not realize it yet. Some of you have been trading for a very short period of time. You don't know if long term you will continue to make money. Maybe you've done well so far. Maybe you're not doing well, and but you also don't have this information. You're just trading blindly. So you don't actually know what areas you need to fix so that way you can achieve profitability. So by knowing this information and going through the formula I'm going to show you today, you're going to be able to get a handle on that and know exactly where you're falling short. That's why I said I think this is more powerful than any strategy or signal or something that I could show you guys this weekend, based on the severity with which this problem exists. These problems, not having these numbers, not knowing your numbers, not knowing your data, not having tested your plan. That's more critical than anything else. And more importantly, if you're trading real money and you don't have this information, it's really a losing game, and you're really doing nothing more than gambling. And again, we want to be the casino, not the gambler. So what is this formula called? It's called the Expectancy Formula. Now, some of you may already know what this is, so this could be a snooze fest for you, but I imagine a lot of you don't even know what this is and haven't even ever analyzed these numbers in the way we're going to do it here today. So the first thing that you need to get as part of the Expectancy Formula is your expected winner. Now, your expected winner is going to be a positive number, of course, because this is our winning side of trades. As we know, or if you don't know, when you trade, you're going to have winners and losers, of course, but there will be gains and losses, right? There'll be gains from the winning side of your trades, and there'll be losses from the losing side. And when you put them together, obviously that's your net. That's how much you're actually making, if any. So the first thing we need is our expected winner. To do that, we need our average winner multiplied by our win percentage. Win percentage will be represented as a decimal. And we'll go through an example here, so don't worry. All right, so again, expected winner is a positive number, and it's going to be your average winner multiplied by your win percentage, which will be represented as a decimal. Now, average winner, again, could be pips, points, dollars, ticks, doesn't matter. Just be consistent. Whichever one you pick, be consistent throughout the formula. Also, now you need your expected loser, right? We said you have your winning side and your losing side. This will be a negative number, right? This is an expected loser. What's my expected loser over time? What am I getting? Well, to do that, we do your average loser multiplied by your lose percentage, again, represented as a decimal. So let's say your lose percentage is 25%, so 0.25, right? Pretty simple. Hopefully you all are with me. If you're not, just rewind the video, go back, watch this again. Don't want to spend too much time on it. I want to keep this video short. So your expected average trade, this is the result of the expectancy formula. This is what you're trying to get. So how do we get that? Well, you get the first two parts that we had and you put them together. Your expected winner plus your expected loser. Or you could look at this as expected winner minus expected loser, because expected loser is a negative number, right? So just math, guys. Doesn't matter how you represent it. Just understand you're taking a positive number and putting it with a negative number. So whether you add the negative or you just subtract from the winning side, it doesn't matter. Either way. So what are some best practices about this formula? Well, obviously the higher the end result, right, that expected average trade, the higher the better, right? The more profitable you will be if it's greater. If it's too small or if it's zero and it's negative, those are all bad. You don't want that. If it's too small, you probably won't cover commissions and other kinds of things you have to deal with as a trader, spreads and so on. Just the cost of trading. You're going to be a trader, you're going to have to deal with those costs. Can't get rid of them. You can go with brokers that offer low spreads and low commissions, of course. But if it's zero or negative obviously very bad. Too small, it's not great. If it's zero, of course, it's not good either. In many cases, guys, traders I talk to, and we run this formula, it's negative. It's negative. And sometimes it's positive, and I can talk about that as well, and how you can kind of fix these issues, how you can get these numbers where you want to be and what you need to look at. So we'll go through that example, and then you'll see, okay, now how do I fix it? You must have proper testing sample size. That's critical. And this is what I really want to talk about when I just mentioned some traders may have a positive expected trade, but they've only been testing some trades over like a month or a couple weeks, maybe a couple months. And maybe they've only got like 25 or maybe 40 or 50 trades spread across multiple currency pairs. Guys, our recommendations for testing, which you may have heard us say before, is 100 trades per strategy, per market, on the time frame chosen for the portfolio that you're trying to develop. So let's say you've chosen the 60-minute chart across your portfolio. You're going to be a swing trader, and you've got 4 currency pairs that you're working with. And you've got one strategy that you're practicing or working on developing or testing. That would be 100 trades per market. You've got 4 in your portfolio. That's 400 trades, guys. 400. Or maximum of 5 years back. Now you can disregard the 5 years, just all that to say, trying to get 100 trades per market within 5 years on a swing trading time frame, the higher you go, it can be more difficult. So we say, okay, if you go back 5 years, that should give you relative certainty that what you're doing is going to be profitable long term. Now, most of you would never even think of doing that much testing. And I'm sorry to say that's maybe why you're failing. I'm not trying to be rude, but I'm trying to be very to the point and blunt and honest. As you guys know, at Trade Empowered, we're nothing but honest. It's hard work, discipline, dedication, testing, hours and hours and hours of testing. That's what makes a professional trader. Obviously, you need to have skill set. If you have no skill, you're not testing anything. But again, 100 trades per strategy, per market, per time frame. If you have too small of a sample size and you have a positive expected trade, the data size is not big enough to prove long-term profitable. Some of you are saying, well, I've already been profitable. It's been like 2 months and I've got like 50 trades across like 8 currency pairs. Well, do you want to be profitable for just a couple months or a couple weeks? Or do you want to be profitable for years at a time? Multiple years, right? You want to be doing this as long as possible. So would it stand to reason that you need to have a bigger testing sample size? I think you'd probably agree with that. So let's look at an example. So to get our expected winner, that's what we need first. Again, remember, expected winner is average winner multiplied by your win percentage. Again, win percentage would be represented as a decimal. So in this case, let's say our average winner is 50 pips. Our win percentage is 75% or 0.75. What does that look like? Well, 50 pips times 0.75 is 37.5 pips. Again, Expected winner, this would be a positive number. Okay, pretty simple. So what about moving on? The expected loser, we need that side. So what is that? It's its average loser, again, multiplied by the lose percentage, as we talked about earlier in the slides. Average loser, let's say it's negative 50 pips. I just put the negative in there to keep it kind of consistent with remembering that this is a negative side of your trading, right? And let's say your lose percentage is 25%. Again, 75% out of 100, what's left over? 75% was your winning percentage. Obviously, you have 25% as your losing percentage, and that would be 0.25. Put it out. Minus 50 pips times 0.25 is negative 12.5 pips. Now, you don't need the decimal pip here, guys. I'm just keeping the math consistent with the one decimal place at least. You can just really round these. It's not really necessary to know your half pip or point pips or whatever. So what's your expected trade then? Well, all you got to do is put these together. 37.5 minus 12.5 is plus 25 pips. Again, you can add the negative or just subtract it from the positive side. Doesn't matter. You're coming up with 25 pips. Again, over time. It's critical. Again, we talked about it. Sample size. If your trade sample size that got you your average winner, average loser, and win and lose percentages is too small, it's not very valid. I don't have belief in that number that I get, even if it's positive. This 25 pips, even though it's positive, if I only had like testing results or demo trading or maybe even live trading, any of your results you can get from this, if I'm doing it and it's only like a couple months or a few weeks, I don't have solid faith that that's a quality number of plus 25 pips. You guys with me? Okay, so we want to have solid sample size of data feeding this formula. The formula can only give you what is put in. If the numbers are junk in, junk out, right? All right, guys, but here's the secret. As the numbers that we just went through as an example, you don't even need to be that good. You don't. You don't need to be a 75% accurate trader on your win percentage. You don't need to be. And I'm going to show you how right now. So right here, guys, I've got my Excel sheet. I've basically set up the first example that we had in the slide deck there, already in the spreadsheet. Now, guys, you could do this. I'm not going to have it for download, so don't ask. But it's very simple to create. It was not hard at all. So you have the formula there. Go back, rewind the video, write it down in Word form, and then write out the example numbers. Throw it into an Excel sheet just to do some, practice examples. Use your own data. Find out where you're at. That's the whole point of this video, guys. I want you to see where you are with your trading. You got to be honest about this process. Many traders are dishonest to themselves. I was dishonest to myself. You must be honest with where you're really at. Be realistic. Live in reality. Don't live in your emotions. And you'll be able to evaluate where you're at much more easily, quickly, and effectively. So the first example we had was 50 pips, and a 75% win percentage. So again, we come out with 25 pips overall. I just rounded it off. Again, we're not using the decimals here. There's no point. So what's another example? Well, a lot of times I find traders who do this. They've got a 75% win percentage, but their average winner is very tiny. So they have this high win percentage because they're taking targets very close to their entries because they're worried about losing the money and they want to get money in the bank, right? That's what they're worried about. How can I increase my win percentage? Well, I'll just decrease my target. But their stop loss or their risk, and maybe they're not trading with a stop loss, is 100 pips, right? Maybe it's 100, or they move their stop loss because they just want to be in the trade, and the trade's going to turn around. They just keep moving my stop loss, keep moving my stop loss, keep moving my stop loss. Eventually, the market's going to turn around, right? Well, no. Eventually it will, but you may go broke before that happens. But we can see here that this gets us an expected trade of minus 14 in column E. You see that? Minus 14 pips. That's bad, right? What do we say? Too small, 0, or negative. Bad. No good. You will not be profitable. No amount of money management will save you from this. Can't change position size to make this work. The math just doesn't add up. So I find this a lot. People have a high win percentage because they think that's what they need, which can be helpful. I'm not saying it's not, but they don't look at their risk and reward, their average winner and losing side, because they're reckless with their stop loss, or their targets are too tiny and their risk is just too great, and the math just doesn't work out. Something else that I find quite frequently is that, let's go back to 50 and 50 for average winner and loser. And something else that I find is that the win percentage is very low. This trader is very good at risk reward. They're very good. They got the risk reward all laid out. They know they need 1-to-1. If I risk 50, I want to make 50 no matter what. But the places in which they choose to take these trades while they put on good risk reward, they're not correct enough. The place in which they're expecting the market to move in their favor is not happening often enough to their first 50 pips, right? To their target, their first target, if you're trading multiples or whatever, right? What we find is 0.25%. Great risk reward trader, low win percentage. Look at the expected trade, minus 25 pips. Again, you can't overcome this. No amount of money management will save you. Traders all about the position size. I hear it a lot. Get a lot of questions on money management. But those traders, they don't have the results. They don't have the plan. They don't have the profitable skill set. And they're just doing some things that aren't helping them. So again, 50-50 pips, winner to loser on average side, but my win percentage is too low. I come up short. Again, I'm negative. There's no way to fix this with anything else but having a higher win percentage or having a greater average winner. So I want to talk about that here in a second. But what did I say? Here's the secret. You don't need to be that good. What was our original setup? Was it 50-50 and 75%? Right? What if, say, you were only 55% accurate? Right? You're nearly 50-50 chance. You put this on, it's like flipping a coin. Heads or tails, I don't know, 50-50 chance. A little better than 50-50 would be nice. So I will say 55% accurate. So what do we see there? That expected trade number is 5 pips. Or dollars, whatever your numbers are. But it's really low, right? What do we say? Too small is not good. So I'm good with my risk reward. I'm 50-50. I'm about 55% accurate with my current method, let's say, as an example. Well, what would I need to do to make this better? What do I need to do to increase my expected trade number? Well, if I can't really figure out I don't have enough skill to be much better on the win percentage side because I don't have enough technical skills in order to put me in better places in the market. Maybe I can just shoot for a larger target. Maybe that'll work for me. Well, what would happen if I had a 75 pips average winner over time versus a 50 pip loser at my meager 55% win percentage? Now, guys, if you've ever heard of Keel Talk, he's about a 55% trader. And we all know he's successful, yes? So, again, you don't have to be 85% or 90% accurate or 75%. Does it help to be a high win percentage? It can, but it's all relative. You got to have good risk reward as well. What does that get us if we go up to 75 versus 50 for our average loser? Well, 19 pips. That's pretty doggone good, guys. That's pretty good. We don't want it too low. My ballparking is around 10. I'd like to see it a 10 or above. 10's kind of low, but that's my minimum that I'd ever want to see. Guys, traders that come through our programs and our training, primarily our primary training course with Akil, they're looking at numbers like this: 19 pips, 20 pips, 30 pips, 40 pips maybe, depending on the trader or the strategies used for the expected trade outcome. Those are the kind of numbers you want, right? So how do you fix those problems? Well, again, you either need to increase your win percentage. If you have a 50-50 pips, or maybe it's 75 average winner and 50 loser, but your win percentage is only, 30%. You're negative. So in this scenario, what do you need to do? Well, you need to find higher probability turning points in the market by increasing skill. You need to improve your win percentage, basically. Or let's say you have a high win percentage. Maybe you're a 75% trader. All right, but again, your loser, like we had before, was too great. What was it, 15 to 100 or something like that, something crazy. You got a high win percentage. What might you want to sacrifice here? Well, you definitely need to have a more reward, right? And maybe your risk is too great. Maybe you're having problems with your stop loss. You're moving it, like I said. The only way you can fix it this way is we need to increase our average winner and likely decrease our average loser. So guys, if you risk 50 pips and you can make 50 pips at a 75% win percentage, if you set yourself up for a 1-to-1 risk reward and you're 75% accurate, you've got an expected trade of 25 pips on average. Again, over time, it's on average. It's not every time you trade you get 25 pips, right? Because there's winners and losers. But over time, you can expect to make money. Well, how low can we go with this? What about our 55%? Well, a little low, right? The expected trade's only 5 pips. That's a little low. But guys, just 75 pips, right? 25 pips more on the winning side on average. I'll come up with a positive expected trade that's 19 pips. Guys, this is the kind of analysis that you need to do on your trading right now. This formula, again, I said less than 10 minutes. The video is obviously not 10 minutes long. But once you've got this formula, it will take you less than 10 minutes to input these results, if you have them, average winner, average loser, win and loss percentage, into this formula and find out where your trading is right now. Today, right now, you can find out, am I headed for disaster? If you're new to trading, or you've been trading just for a little while, and maybe you're negative, or maybe you're slightly positive, or maybe you're doing really, really well so far. Maybe, right? See where you're at. And remember, the quality of data in. If you have low sample size of trades taken in order to come up with your average winner, your average loser, your win and loss percentage, even if it's a positive expected trade, you run the risk of having not enough trades taken within a specific currency pair with your strategy on the time frame you've chosen to trade on. And if it's not enough data, not enough trades taken, I'm not going to believe in it. Neither will you, and that's part of the problem. Guys, I hope this video helped you today. I hoped it helped you. Again, this is more powerful than any signal or, hey guys, I'm looking at this trade. That's valuable. There's a place for that. But too many traders are walking around out there without looking at this kind of a thing. They just aren't. It's not important. Show me the next signal. Show me the system. Show me the strategy. Or if I'm just trading, I'm trading. Show me the next trade. You need to be independent. You will not be independent if you're only relying on someone else. Now, we're here to help you reach the independent stage. That's why we put trade ideas out. That's why we do the Forex market preview. That's why we do all that stuff and put out those videos and have other services that show you trades. Nothing replaces you. And this is a quick and easy way to analyze your trading today. Find out where you're at and find out where you need to improve. All right, traders, I appreciate your time today. I know we didn't have any trades to look at, but again, I believe this is more powerful for most of you based on where you're at with your trading, that this will help you more than any trade idea I could give you. Have a great one, guys. Have a great weekend. Have a great week. Be great and be professional traders. Have a good one.